Hello, welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here again. Very good morning to all. Today will be Thursday, the 15th of February, 2024. So before we start our Daily Dose of Market Insights, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, and as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the technical outlook, the short-term technical outlook on the cross assets, let's have a recap of what happened overnight and early this morning. So in the overnight US market, the benchmark US stock market managed to stage a recovery after that sell-off from Tuesday, shocking US CPI data that was hotter than expected. All the major benchmark stock indices rallied, actually led by the heavy cap, the mega cap US stocks, the mega 7. That means that tech stocks, I would say, with the Nasdaq 100 up 1.18%, S&P up 0.96%, the Dow Jones Industrial up marginally 0.4%, and the Russell 2000 up a positive 2.44%. So if you look at the heat map of the S&P 500 over here, let me share with you all. All right. Okay, so it's a bit slow here. So what we could see over here is almost a sea of green across the board. All right, so what we could see over here is the optimism could be pretty much heavily related to the AI play as well, where we in the mega cap stocks, NVIDIA came in as the top performer, positive 2.46%. No, in fact, it's not NVIDIA, in fact, it's Meta, Facebook up 2.86%. So what we could see over here is pretty much driven by the technology mega cap stocks. All right, so all in all, what we could see over here is it was actually also due to that main catalyst, which is always the cost of funding, which is the US 10-year Treasury yield. So what we could see over here is that the US 10-year Treasury yield, let me highlight to you all. Okay, the US 10-year Treasury yield managed to actually hit and reacted off the I would say at the 4.35% level around this red line here, slash the upper limit is 4.50, which is the 61.8% FIBO retracement. So it managed to actually stage that very reaction of the lower limit of this major resistance zone, which is 4.33 slash 4.50. So for sure over here is that there could still be a bit of because of that residue, that slide in the US 10-year Treasury yield yesterday led to this rebound or recovery, intraday recovery that was seen on the US benchmark stock indices. So very clearly for sure that we know that there's this strong intermarket relationship between US 10-year Treasury yield and the benchmark US stock market. So put it away intuitively that use that the fact that the 10-year Treasury yield is as a cost of funding, which is related to the Fed dovish pivot narrative that has already been a strong movement that induced the bullish behavior of market participants towards the benchmark US stock indices since October last year, and it has been amplified after December FOMC meeting, where Fed Chair Jerome Powell actually guided market that, hey, we already reached the peak of the interest rate hike cycle, and the next step is for us to decide the pace of the interest rate cut and when to cut interest rates. All right, so if we start to see the the initial bullish candle on Tuesday was actually driven by the stronger than expected US CPI data, which reduced the Fed dovish pivot optimism that saw the spike up in the US 10-year Treasury yield, indicating to us that the cost of funding will also increase, which doesn't bode well for what you call it a company that actually rely on borrowings. So this will call that long duration equity, like for example mega cap tech stocks will be one of them, and as well as the Russell 2000 will be much more important. Why? Because the Russell 2000 component consists of I would say majority of the constitutes in the Russell 2000 has a weaker balance sheet. That means they rely on what you call it lower cost of funding to actually leverage up their business operation. So for sure, if we start to see a downward move in the US 10-year Treasury yield, will benefit this segment of the US stock market. And you know that most importantly, the mega cap stocks is the leading sector of the US stock market, or the leading team play of the US stock market. Any substantial recovery in the mega cap stocks, which we could see in the Russell 2000, has a positive sentiment spillover effect with the rest of the major US stock market as well. All right, so this is the linkage I want to share with you. So given that the 10-year US Treasury yield has managed to inch downward, the dollar index also remains muted yesterday. So we talk about the dollar strength. It actually came, dollar index was down slightly, negative 0.14%. But however, if you look at overall the picture of the dollar, it seems to be pretty much mixed yesterday, because the sterling dollar actually broke below the 200-day moving average yesterday. All right, so later I'll share with the short-term technical outlook chart. And we still see WTI crude oil price yesterday did a fallback below the expected 78.40 range resistance that we highlighted yesterday, and gold remains pretty much weak as well. Traded sideways yesterday, but they managed to recapture the psychological level of 2000, which is the XAU/USD. Okay, so this morning, right, one key news highlight I want to highlight you is the Japanese economy. So the Japan actually slipped into recession. So what we could see over here is that this is the preliminary Q4 figure. So the Q4 growth rate Q on Q actually went down negative 0.1%. Because it was 2 consecutive quarter of negative growth, so that actually defined as a technical recession. And what's most importantly over here is that market expecting a recovery in Q4 last year in Japan. In Q on Q figure, they expect 0.3%, annualized much more better at 1.4% year on year. But however, it came in negative 0.4%. So if you look at the situation in Japan over here at this point in time, it seems to us that this weak economic growth, all right, okay, is more linked to what I call, okay, let me put it, okay, let me highlight for you all. Okay, it's due to elevated cross, okay, so it's basically elevated cross pressure and as well as global headwinds. So this cost pressure over here is actually putting a dent on consumer spending in Japan. This cost pressure is primarily driven by that last year, between Q3 to Q4, there's this the second half of last year, there's this rapid up move in the dollar yen that causes the yen to remain at multi-year decade weakness. So a weak yen actually could not offset elevated external costs. All right, so that actually putting a damper on consumer spending. So that actually explain to us, despite the fact that we see a very weak Japan GDP data that undershoot market expecting, the dollar yen didn't actually rally much. So if you look at the performance, this is a 5-day rolling performance as of today. The dollar yen in fact actually didn't actually spike up. Okay, so usually, right, when we start to see a very weak, any key economic data that is weak from Japan, the market will infer that the BOJ will continue to actually maintain their ultra dovish policy and see a spike up in dollar yen. That means yen weakness. But however, this time around, we didn't see a spike up in dollar yen. Two things that could actually explain it. One, the weakness that was seen in the GDP data is due to elevated cost pressure that put a damper on domestic consumer spending. And this elevated cost pressure is related to a weak yen. So definitely a weak yen right now is not unfavorable to the current context of Japanese economic affairs. And do not forget over here is that yesterday I highlight to you that the Japan finance minister, vice finance minister that is in charge of currency affairs is actually watching the market very closely after the strong US CPI number. So there could be also a high risk of intervention going into play. Why? Because it's coming very close. The dollar yen is actually really coming into the zone of a major resistance level, which I'm going to share with you all in a while's time. All right, so that is the key, one of the key data that took shape today. And another one I want to highlight is over here is the yeah, AU, Australia. Okay, one second, I think it's a bit lagging on my side. Yeah, AU unemployment change job data. So the AU unemployment change job data came in below expectation. So market is expecting a recovery to 30K jobs added for the month of January, but it came in way below expectation, only 0.5K job added. So that actually explained this morning's Asia session. There was a bearish reaction on the Aussie dollar right at the short-term pivotal resistance that we highlighted yesterday. All right, so that's actually sums up for the key data that was took shape yesterday, and how does it took shape a while ago, and how does it impact the respective asset classes. Okay, so now let us now jump straight to the short-term technical outlook. All right, so let us start with the FX market first. All right, so FX market. So we know that the FX market over here in my screen, this is the 5-day rolling performance as of today. The dollar strength that was seen on Tuesday exposed strong US CPI data has started to temper off a fair bit over here. All right, so what does it have in store for the various major currencies? So we've got to take things one step at a time. To me, it's rather mixed at this juncture. So let's start with the euro dollar first. So for the euro dollar in this instance, okay, let me open up the euro dollar. Okay, so now let me expand my screen. Okay, this is the euro dollar chart. Okay, so for the euro dollar chart, what I could see clearly is trading in this medium, I would say that short-term descending channel in place since 11th of January high. All right, and price action, yes, it actually yesterday shaped a bounce, but it still remains the short-term pivotal resistance at 1.0760, and also right now there's a resistance that has really been seen on the hourly RSI as well over here. Okay, price action being kept, all right, by this. Okay, so with that, right, there's no change in the outlook, the short-term bearish outlook that we have for yesterday. So we'll still maintain the short-term bearish outlook on the euro dollar, given the still prevailing current negative technical elements that I show you at this juncture. So 1.0760 will be the send in the mud, which is the short-term pivotal resistance. Still maintain the short-term bearish bias, with the near-term support level to watch will be at 1.0665. Potentially, this could be the lower boundary of the lower limit of the descending channel, and as well as the confluence with this area over here, the minor swing low area of 8th of November and 13th of November last year. Only an hourly close above 1.0760 will negate this bearish tone to kind of see the next near-term resistance to come in at 1.0795, which confluence with the upper limit of the descending channel, and as well as the 20-day moving average that is, I think, that is soon to come to act as a resistance at this 1.0795 level as well. Sterling dollar. So sterling dollar is the one that came down, broke below the 200-day moving average yesterday, and right now is actually attempt to retest this level. So given the break of that 200-day moving average yesterday, we potentially could see a bit of slight weakness on the sterling dollar to test the psychological level, to expose the psychological level of 125 figure. So with that, right, I do not want to put the short-term pivotal resistance today at this level. Okay, which is kind of tight, okay, at 12610 level is a bit tight, so I'll use 12670, which is the start of this, we call it short-term push down, all right, that has taken shape since Tuesday, exposed CPI data, and as well close to the downward sloping 20-day moving average. So with that, right, 12670 short-term pivotal resistance, with this level to maintain, to flip to a bearish bias, kind of a very short-term bearish bias on the sterling dollar, with the near-term support level to watch will be at 125 figure level. All right. A break below 125 figure level potentially exposes the next support zone, but you got to break below 125 figure level first. The next support zone at 12420, 124 figure level. So what's 12420, 124 figure level? Is in fact the 50% Fibo retracement, okay, of the previous medium-term up move from October last year, 4th October last year low to 28 December last year high. Okay, the 50% Fibo retracement, and as well as this graphical congestion area of 6th of November and 17th of November. Okay, all conferencing at 124.20, 124 figure. Okay, only an hourly close above 126.70 will invalidate this short-term bearish bias to see the next near-term resistance coming in at 127.60, which has been a range resistance in place since 15th of Jan this year on the sterling dollar. Then what we have over here will be the Aussie dollar. So Aussie dollar continue to remains weak. So we see this is the bearish reaction after hitting the 65 figure short-term pivotal resistance that we highlighted yesterday. So this bearish reaction was kind of being reinforced by the weaker than expected AU job number that I highlighted to you all a few minutes ago. So no change as long as 65 figure short-term pivotal resistance holds, we will still maintain that short-term bearish bias. First near-term resistance support level to watch will be at 64.50. A break below it exposes the next support at 64.10, 63.90. Only an hourly close above 65 figure level will negate this short-term bearish bias to see the near-term resistance coming in at 65.40, pardon me, slash 65.60, which is confluence it with a graphical resistance range resistance of 7 of Feb to 13 of Feb, and as well as the 200-day and the 20-day moving average also acting as a resistance at this zone as well. Okay, dollar yen. So dollar yen will be pretty much mixed. So what you see on the dollar yen on the daily chart. So I will start with, I will explain over here. So this is the intervention zone that actually took shape 2 years ago, around 1.5 years ago, pardon me, 21st of October 2022 at this 1520, 15195. The upper limit is 15195. That was tested 2 times last year before that last medium-term down move took shape from 13 November all the way down to the low of 27 December last year. So right now we are really approaching this danger zone where potentially market participants has a regency bias that MOF will instruct BOJ to intervene. That means, i.e., to sell dollar, buy yen. That could potentially push down the dollar yen at this zone over here. And what is seen over here is that after the Tuesday spike up, we start to see verbal intervention, or I would say strong verbal intervention from MOF, Vice Finance Minister himself, that is in charge of the currency international affairs, which is i.e. the currency market. So with that, right, that actually explains why, despite the very we call it a weak GDP number, the Q4 weak GDP number in Japan that I highlighted a while ago at the start of this daily dose for today, it doesn't induce a strong move up in the dollar yen that it tends to be in the past. Okay, so with that in the picture, right, if you look at the short-term technical outlook, that means we we drill down to the hourly chart right now. The momentum has been pretty much weaker. So what we could see over here is that the RSI now has really broken below a parallel support level. So you see price action going to move up higher, higher, higher high, higher low. But the RSI yesterday broke below this parallel support, now turns into a pullback resistance and start to shape lower high. Okay, this point in time. So with the very lackluster momentum reading as expressed or inferred by the hourly RSI indicator that I flashed to you, this is the hourly chart. So it means that over here in the short term, technical elements now are rather mixed. Yeah, we still see a uptrend that is still prevalent, as depicted that price action didn't break below the lower boundary of this minor ascending channel support that I drew from the low of 2nd of February. But the RSI is not depicting the same way as the price action. The RSI, being a derivative of price action, is showing weakness instead. So with that, right, RSI could be a pre-warning sign that the upside momentum of this ongoing, we call it short-term uptrend on the dollar yen is losing steam. All right, so with that, yesterday we do have a bullish bias holding at 149.60. looking it for the first resistance at 14140, maximum will be 141 151, pardon me, a bit tongue twisting, 15140. Upper limit will be at 15195, so that's the upper limit of the major resistance zone that highlighted on the daily chart for you a while ago. So given the weakness on the hourly RSI, with that, I will actually be not so confident to maintain that short-term bullish bias on the dollar yen that we have yesterday. So with that, I will flip to a neutrality stance between 150.70, which is yesterday's minor swing high level, and as well as today's Asia session, start of Asia session before it attempt to test, then the intraday sell off took shape. So neutral between 150.70 and 149.60 for today on the dollar yen. Only an hourly close above 150.70 will reinstate that bullish bias for the next near-term resistance to come in at 151.40. All right, so what we could see over here is a rather mixed bag on the dollar picture for sure. So what we could see over here is that a bit of mixed element in the dollar yen with risk of we call it MOF intervention. So we also be a bit more cautious on the rest of the other dollar currency, because if the Japan MOF starts to come in and intervene in the yen side of the story, it could actually create what I call a kind of dollar strength sell off or dollar strength bearish reversal across the board as well. So something to be aware of, I mean, in terms from a risk management perspective. Okay, now major stock indices. So major stock indices, let us start with the Nikkei 225. So the Nikkei 225, no change. We still maintain that bullish outlook. So given the fact that over here is, yeah, we know that despite the fact that GDP numbers tends to be lagging, it's not leading. Uh, the technical outlook as well on the Japan 225 remains positive. So what we could see over here is that the price action continues to trade higher high and higher low. So after the fact that despite the short-term near jerk reaction intraday after the release of the weaker than the softer GDP numbers, market managed to stage a bounce right off at the minor ascending channel support that I drew from the low of 2nd of February. All right, so RSI continue to shape higher low, okay, above the just right above the 50 level mark, okay, indicating to us that the short-term bullish momentum still remains intact. So I do not want to put it so tight. So what we could see over here, there could be a minor pullback support coming into play around this level. All right, at 37,790,000, okay, 37,790. But you putting this as a short-term pivotal support level is a bit tight. So no change. I'll be still using 38,420 short-term pivotal support level. So as long as this level is not surpassed to the downside, maintain that short-term bullish outlook on the Japan 225. Resistance to watch. Next resistance to watch will be 38,670/780, and to be bear in mind that we are now approaching the current all-time high that was seen way decades ago. I would say more than 20 years ago at 38,957, which is the December 1989 level. Okay, only an hourly close below 38,420 will invalidate this short-term invalidate this short-term bullish outlook, pardon me, to see a corrective decline, a minor corrective decline to retest 36,880, which is a former minor swing high of 23rd of January, now turns into a pullback support, and also the upward sloping 20-day moving average should actually confluence with this level as well at 36,880 pretty soon. Okay, so that's for the Japan 225, still maintain that bullish bias. Then now back to Hang Seng. So the Hang Seng continue to bounce. All right, so what we could see over here is that this morning it managed to have the intraday sell off, but the sell off managed to U-turn right at the 20-day moving average, I think as a near-term support at 15,720. So this level over here, because Hang Seng tends to be quite volatile, so I don't want to use 15,720 as my short-term pivotal support. So still maintain yesterday's short-term pivotal support level, 15,440. So still maintain that short-term bullish bias for that minor counter trend rebound above 16,250 level exposes the next near-term resistance at 16,525, which is this minor congestion area over here in that was being formed in early January this year. Only hourly close below 15,440 will invalidate this short-term bullish bias for this minor counter trend rebound scenario to see a potential exposure towards the next support level at 15,300, followed by the psychological level at 15,000. Okay, so net overall, still maintaining that short-term bullish bias for the potential counter trend rebound scenario to play out on the Hong Kong 33. Europe, German 30. So German 30 continues to churn within this kind of expanding wedge triangle configuration, okay, that I share with you all, this expanding wedge triangle configuration. So all in all, right, it managed to actually rebound off from the 16,795 level. All right, so with that, right, given that it's now approaching the upper limit of the range, so to have a better kind of a reward risk ratio perspective, so I'll be using this level here. Okay, let me highlight to you. Yes, this level. Okay, so let me remove this. Since I remade, let me move this. Okay. Okay, so a Titan key short-term pivotal support for today is 16,870, which is pretty much close to the 20-day MA as well. First resistance to watch 17,040, then thereafter followed by 17,130, 17,155, which is the upper limit of this expanding wedge triangle configuration. Hourly close below 16,870 negates this bullish tone to see a retest of the previous Wednesday swing low at 16,795. All right, so still maintain that short-term bullish bias with a Titan key short-term pivotal support on the German 30 index. Okay, US benchmark stock indices. So let us start with the US Wall Street 30. So US Wall Street 30 going to churn higher, higher high, higher low, holding above the 20-day moving average. So over here, this could be the near-term support level to watch. Yesterday's swing low at 38,244. But I don't want to use this as a short-term pivotal support level, or it's a bit tight. So still maintain that 38,060 level because it hasn't surpassed the near-term resistance at 38,560. So this is something like a trigger point of that off that took shape on the release of the US CPI data on Tuesday. So given this 38,560 is not being surpassed to the upside, still maintain that 38,060 short-term pivotal support level, maintain that bullish short-term bullish bias. For sure, first resistance to watch, 38,560, followed by above it exposes 38,950 / 38,970. Only hourly close below 38,060 short-term pivotal support negates this bullish tone to see the continuation of the minor corrective decline towards 37,800 / 37,580 support level. Next, Nasdaq 100. So for Nasdaq 100 over here, what we could see over here is that it's now fast approaching the first resistance level, the breakout point that trigger off that steep sell off on Tuesday, 17,840. So this level is not being surpassed to the upside yet. So I do not want to squeeze the short-term pivotal support levels to be so tight at 17,635. Okay, so I'll be using 17,500 level. So 17,500 level still will be the short-term pivotal support to watch to maintain that short-term bullish bias on the Nasdaq 100 above 17,840 exposes the next resistance in the first step at 18,000 / 18,030 level. All right, so that's pretty much sum up for the short-term outlook on the major benchmark stock indices globally. So all of them are still holding above their pivotal support and managed to stage a rebound yesterday. So we will still maintain that short-term bullish outlook. All right. So now going to WTI crude oil. So WTI crude oil, it did that bearish reaction as expected right at the range resistance of 78.40. So why this 78.40 is pretty much important, because it's this complex looking triangle configuration upper limit that is in place since 14th of November last year. So it managed to actually stage that bearish reaction right off 78.40. So for sure, this is a key clear technical resistance level to monitor and reintegrate back below the 200-day moving average. So it's coming very close to the support level that we highlighted yesterday, 75.75. So potentially it's now coming very close to the oversold level as well. So there could be a minor bounce taking shape today from the intraday basis. Bounce level potentially resistant, near-term resistance 77.25. So I don't want to use 77.25 as a short-term pivotal resistance for today to maintain that short-term bearish bias on the West Texas oil for it to actually we call it a churn towards the lower limit of this triangle range configuration over here. So any potential bounce that shouldn't surpass 78.40, we will still maintain that short-term bearish outlook within this complex triangle range configuration for West Texas oil. A break below 75.75 near-term support exposes the next support at 74.20. Okay, only an hourly close above the 78.40 level, that means appears above it, will negate this bearish bias to see the next near-term resistance to come in at 79.80, which confluence with the minor swing high area of 14th of November and 30th of November last year. Okay, so IE still maintain that short-term bearish bias within a complex triangle range configuration for West Texas oil. Now, lastly will be spot gold XAU/USD. So spot gold XAU/USD going to remains weak below the 2000 psychological level. So still no change, still maintain that short-term bearish bias below the 2013 short-term pivotal resistance. The resistance, the key support level to watch will be 1975/1965 with confluence with the 200-day moving average, and as well as the V-shaped rebound that has taken shape in 13th of December last year, right after that dovish Fed Powell guidance in that December FOMC meeting. All right, only hourly close above 2013 short-term pivotal resistance will invalidate this short-term bearish bias to potentially see a start of another choppy recovery towards the 50-day moving average and 20-day moving average, I think as a resistance at around 2030/2036 resistance zone. Okay, so that's pretty much sum up for the short-term technical outlook. Key data to watch out for today will be UK preliminary Q4 GDP growth rate out at 3 p.m. Singapore time. And thereafter, we do have ECB President Lagarde will be speaking publicly at 4 p.m. Singapore time. And with that, US retail sales at 9:30 p.m. Singapore time. And that's pretty much sum up for the key economic data to look out for as we head into today's session. Right, so with that, have a great day ahead, and we shall speak again tomorrow.